In this video, we're going to look at the balance of payments that records all transactions with the rest of the world. Now, the balance of payments will include three types of transactions. The first one is trade flows. This is sales of goods and services abroad, of purchases of goods and services from abroad. The labels we will use is exports, when we sell goods or services to the rest of the world, imports, when we buy goods and services from the rest of the world. The sign convention will be very simple. Exports will show up with a plus sign, imports with a minus sign. Those are the two trade flows we'll record on the balance of payments. Then we'll also record income flows, what we have called earlier net factor payments. This includes several types of flows. The two more common ones are profits that cross borders, or remittances, which are wages paid to workers in one country, and these workers send the money back home to their home country. Now, this can go in both directions. It can be that our companies or our workers repatriate profits back home, and this will show up with a plus sign in our balance of payments, or it could be the other way around, that foreign workers or foreign companies are sending some of these profits or remittances abroad, and then it will show up with a minus sign on our balance of payments. Finally, we're going to record all capital flows. Capital flows will have, again, two directions. It could be capital inflow. It means foreigners acquire domestic assets, or it could be a capital outflow, which means our domestic investors are acquiring foreign assets. The convention here would be that any capital inflow will show up with a minus sign. Any capital outflow will show up with a plus sign. Now, what we're going to do with all these transactions is put them into two separate balances, which are sort of sub-balances of the balance of payment. Now, let's think about some examples and how they would be recorded according to the type of transactions we see in the balance of payments. For example, a Japanese company sells a camera to a German consumer. This is an export for Japan and import for Germany. This is obviously a trade flow. Here comes a capital flow. A US company acquires a manufacturing facility in Myanmar. This is a capital outflow for the US, a capital inflow for Myanmar. The Chinese central bank buys French government bonds. This is a capital flow as well. It will be a capital outflow for China, because capital goes from China to France, a capital inflow for France. A Singaporean worker who's working in Portugal sends some income back to Singapore. This is an income payment. An income payment will show up with a positive sign in the Singapore balance of payments, with a negative sign in the balance of payments of Portugal. What if a Brazilian company repatriates profits back to Brazil from operations in Spain? This is another income payment. This is a repatriation of profits. It will show up with a positive sign in Brazil. It will show up as a negative with a negative sign in Spain. Now, let's record now the two sub-balances of the balance of payments. We'll start on the left-hand side, and we'll call that balance the current account balance. Here we're going to include two things, the trade flows and the income flows. The trade flows will be exports and imports with a corresponding sign. If we calculate the difference between exports and imports, we refer to this term as net exports. And net factor payments will have as well some positive and minus items, and the balance of that will be the net factor payments. If we aggregate all the trade flows and the income flows, we will have the current account balance. Now, on the right-hand side, we're going to include all the capital flows. Capital flows will take many forms. It will be any change in domestic holdings of foreign assets. So our investors, our domestic investors, buy or sell foreign assets. Now here we have to be careful with the signs. If we buy foreign assets, this is going to be a capital outflow, and a capital outflow will show up with a positive sign. If we sell as domestic investors foreign assets, this is a capital inflow, and we're going to record that with a negative sign. Now, what if it's the foreign investors who do the transactions? Same logic, but the sign will be the opposite. Now, when the foreign investors buy our assets, this is going to be, from our perspective, a capital inflow, and it will show up with a minus sign, the opposite if they sell our assets. Now, there's a special transaction what we typically record separately, which is when the investor is the central bank. The central bank holds foreign reserves. Sometimes the foreign reserves might be held at the government, but for simplicity, we'll refer to the central bank. Now, the central bank is simply a domestic investor, so we'll treat it as any other domestic investor. If the central bank buys foreign reserves, this is a capital outflow. It will show up with a plus sign on our balance of payments. So here we have now the right-hand side, which we'll refer to as the capital and financial account. So we have two sides on the balance of payments. Left-hand side, we'll call it the current account. That's net exports plus or minus net factor payments. The right-hand side, we'll call it the capital and financial account, and that includes all possible capital flows done by individuals, by companies, governments, or central banks. Now, when we look at the way we're recording our items here, there's an interesting property that follows, which is the following. All transactions are going to show up twice in that previous slide. And they're going to show up in two possible ways. Either they show up both on one of the two sides, either on the left-hand side or the right-hand side, but in that case, they're going to cancel out. So one is going to come with a positive sign, the other one is with a minus sign. Or they're going to show up on both sides of the balance of payments, one on the current account, one on the capital and financial account, and in that case, they will be identical. So it will always be the case that the current account, the balance of the current account, is equal to the capital and financial account. Just to understand this concept, let's think about just a very simple example. Imagine a country that runs a current account deficit, say because they have more imports than exports. So there's a minus sign on the current account. How do we pay for that? Well, we need to attract some capital to be able to pay for that. That capital could take the form of a foreign direct investment inflow. It could be that we borrow from foreigners. It could be that we sell them some of the foreign assets that we used to have, or it could be that we use the foreign reserves of the central bank to pay for those imports. Now, in all those cases, what we see is a capital flow, in this case, the capital inflow, that is going to show up in the capital and financial account with the same sign and of the same size as the current account. So it will always be the case, because of this sort of double recording of all transactions, that the current account of a country will be equal to the capital and financial account.